Here's a news flash. Mortgage rates not too long ago were back in the fives. Now they're in the sixes. And that one move changes far more than just a monthly payment. It changes affordability for buyers and it changes leverage for sellers. And it also changes how both sides need to think in today's market. So in this video, I want to break down why mortgage rates jumped again, what that means for buyers and sellers here in the San Fernando Valley, and why this is not just a buyer problem. Seriously, it's a market problem. Reuters reports the average 30-year fixed rate interest rate rose back into the mid sixes after dipping down into the high fives in late February, with a move tied to higher Treasury yields, oil prices, and inflation fears linked to the Iran conflict. Hey, I'm Frank Spencer, and after more than 3 decades in real estate, I can tell you this. When mortgage rates rise, most people immediately think about buyers. And that makes sense. Higher rates means higher payments. Higher payments mean lower affordability, and lower affordability means some buyers pause or step out of the market altogether. But what many people miss is that rising rates affect sellers too. Because when rates rise, the buyer pool doesn't just get smaller, it gets more selective, more cautious, and more price sensitive. So if you're a seller, this matters to you just as much as it matters to the buyer. Mortgage rates don't move on their own. They tend to follow the bond market, especially the 10-year Treasury yield. And when the bond market starts pricing in higher inflation risk, mortgage rates usually move up with it. That is what we're seeing right now. Reuters reports that the recent move back into the sixes has been tied to the rising Treasury yields, higher oil prices, and inflation concerns, again related to the Iran war and disruption risk around the Straits of Hormuz. So even though rates have dipped into the fives not that long ago, that improvement was very short-lived. For buyers, the effect is immediate. When rates rise, the monthly payment rises too. And that means the same house suddenly feels more expensive, even if the price hasn't changed at all, or even if it's come down a little bit. And that creates three problems for buyers. Affordability gets squeezed. A buyer may still qualify, but qualifying is not the same thing as feeling comfortable. Today's buyers are not just asking, can I get the loan? They're asking, can I live with this payment? That's a major psychological shift. Buyers become more cautious. When rates rise quickly, buyers start second guessing. They ask, should I wait? Will rates come back down? Will prices soften? Am I overpaying? And once those questions take hold, hesitation follows. Some buyers step back entirely, and this is not theoretical. Reuters reported purchase mortgage applications fell by 2.6% in the latest MBA data, while refinance applications dropped 17.3%. This tells us that higher rates are already cooling market activity. So yes, higher rates absolutely hit buyers first, but that's only half the story. When rates rise, sellers lose something very important. They lose part of their buyer pool, not because nobody wants the house, but because fewer buyers can comfortably absorb the payment. And that changes the seller's strategy in four big ways. First of all, pricing has to become more precise. This isn't the kind of market where you can simply try a number and hope buyers will stretch themselves or, hey, what the heck, they can offer less. When payments rise, buyers become far more sensitive to price. That means small pricing mistakes can have a much bigger consequence. A house that may have felt reachable at one rate can suddenly feel out of range at another. Number two, sellers face a more selective audience. And it's just simple math. When money gets tighter, buyers scrutinize more. They compare more carefully, they notice flaws more quickly, and they hesitate more easily. So sellers are not just competing with the market, they're competing with every other listing that looks cleaner, better, or less risky. Escrows become more fragile. A buyer who's already nervous about payments becomes more likely to wobble once they get into escrow. And they may start thinking, the inspection findings. Oh man, the monthly costs. Did you see what they put in the disclosures? So, how is the value relative to the other options? And that's how deals begin to fall apart. This is where sellers need to stay disciplined because when showings slow down or offers feel weaker, fear starts to creep in for the sellers too. They may overreact, take an offer that's not in their best interest, accept terms they should question, or chase the market downward too late. So rising rates don't just change affordability, they change behavior on both sides. The larger issue here is not just that rates went up, it's that they went up during the spring market when buyers and sellers usually expect to see a little bit of momentum. Reuters noted that this rate jump is landing just as the housing market enters its typical busy season. That adds to pressure at exactly the wrong time. Buyers may feel more cautious right when they're getting ready to move. Sellers may face a smaller, more demanding audience, and both sides may need to reset expectations quickly. This is why I say all the time, markets just don't move on numbers, they move on psychology. If you're a buyer, I'd tell you not to panic, and I would not tell you to rush, but I would tell you to get serious about your numbers. Know your comfortable payment, know your cash position, understand your lender strategy, because waiting only makes sense if the thing you're waiting for is likely to help you more than it hurts you. And that's not always true. If rates rise and inventory stays limited, you may end up paying more later anyway, either through a higher rate, stronger competition, or both. So the right move clearly is not fear, it's clarity. If you're a seller, this is the moment to become more precise, not emotional. You got to compete a little bit. You need cleaner pricing, better presentation, stronger disclosures, realistic expectations, and a strategy that removes buyer hesitation early. Because when rates rise, buyers don't forgive uncertainty the way they might in a heavy, aggressive market. If your pricing is off, they pause. If the condition is weak, they pause. If the numbers feel stretched, say it with me, they pause. And that pause is often where leverage starts to slip. If there's one thing both buyers and sellers should understand right now, it's this. Higher mortgage rates don't just hurt buyers, they change the entire tone of the transaction. They reduce affordability, they shrink the buyer pool, and they increase selectivity. And they force both sides to be sharper. For buyers, that means knowing your numbers and avoiding panic. And for sellers, it means understanding that strategy matters more now than it did when money was cheaper. Because when rates rise, the market doesn't stop, it just becomes less forgiving. So if you're a buyer, don't assume a higher rate environment means you do nothing. It may mean you need a clearer strategy. And if you're a seller, don't assume rising rates are just the buyer's problem. They directly affect your buyer pool, your pricing power, and your path to closing. If you found this helpful and you care about making smart real estate decisions here in the greater San Fernando Valley, I post these videos weekly. They cover market shifts, local insight, and practical strategies designed to help buyers and sellers succeed. And if you're thinking about selling, hey, I wrote a guide just for you. It's called Avoiding a Failed Sale: How to Sell Smart and Walk Away Without Regret. You can download it at my website for free at mrchatsworth.com/ebook. If you have questions about rising rates, pricing strategy, or what this means for your specific neighborhood, drop them in the comments. Promise you, I read every single one. And until next time, I'll see you around the neighborhood.